Okay, if you want the slides, I'll load them up on my website. You can look at this picture, you can download the slides later today. Okay, let me start with this slide. Okay. So what I'm showing you here is that typical bull and bear cycles, how long do they last? Okay. And my sense is that bull cycles last 4 to 5 years. Some people say 7 years, it doesn't matter. But we are now in 4+ years. Okay? So I'm trying to signal to you the market is looking quite tired. Okay? Same for Singapore market. Okay? So we're up 19% a year. So I'm trying to say to you that we're probably looking at going into a bear market for 2 years, but it doesn't seem to make sense, right? If the US economy is recovering like what PK Vasu is saying, so why is there going to be a bear market? I think it's not really a bear market, it's what we call a correction of the market, because interest rates are going to return to normal when they stop printing money. And so the market will then start to look expensive. Okay? So it's more of a correction because of the normalization of interest rates. Okay, so I think this tired bull. Okay? I think 6 to 9 months left, but the caveat is it's an emerging market tired bull. Okay? I think the US market still looks very positive. Okay? So let me explain to you why. Okay, so PK talked about this. I said QE3, the end of QE3 will kill the market. Okay, so when they start the ending QE3, then we have to check whether PEs are fair or not. Okay, so let me explain to you what's going on. So he's going to, this is what he said about, this is what Ben Bernanke said about QE3. Okay, they're going to start buying back forever until unemployment falls below 6.5%. It's now about 7.3%. Okay, so I think he's probably going. I think Basu is correct. I was hoping that he would actually have started tapering this month. Okay, I think that would have been a good sign for the market, and probably do a small tapering, maybe 5 or 10 billion. But he didn't do anything. So I think what he did was he created a false sense that the market would rally. Okay, so where we are now is that the market was actually in a decline for 2 reasons. One, we thought Bernanke would do tapering. 2, we thought there would be a war in Syria. Both didn't happen. Okay? So the market is now in what we call a short covering rally. I think it's your best time to sell. Now, the reason is that this guy is the biggest speculator in the whole market. Okay? He's always wrong. Okay, let me explain to you. Let's look at this. This is this year's chart. Since he mentioned the word tapering, you have a major index like the Dow plus minus 5 to 10%. It is unheard of. A Federal Reserve should be providing stability and guidance to the market. Okay, so now he has created volatility. So to me, the volatility can only end when he starts tapering or makes a serious comment. And tapering will start and when it will end. Okay. I'm hoping he does it sooner than later, because right now, if he doesn't do that, we will continue to see this volatility into the end of the year. If PK is correct in December, then up and down another 5-10%. So can you stand the volatility? Okay, so what I have different from Basu, I think it will end, and I'm hoping that he will start tapering in October and finish by middle of next year. Okay. And this is the most important comment here. I think 10-year US Treasury yields will rise to 4 to 5%. This is the most important slide. Sorry, okay, before I go to that. That second last comment, 10-year Treasury yields to rise to 4 to 5%, is the most important comment that you must take away today. Okay? That's very important. It's going to affect all stock markets around the world. Okay? So this is what's happened. Okay? He pumped up so much money that it's going to have to explode. Right? Okay, so this is why I told you about the most important slide. Okay? 10-year US Treasury yields roughly 4 to 5%. Today they are I think last night they were 2.6%. Before he said there was no tapering, it was already up at 3%. Okay? This is what I call the true risk-free rate. Okay, so what's happened is that when they started QE3, QE1, QE2, QE3, they depressed the real cost of capital. Okay, so what happened was that a lot of money was poured out. There's a lot of overbuilding. Okay, so you look at it. What is the impact? First of all, I think US dollar will continue to strengthen. Okay, so we're going to see what we call, especially against the emerging markets, and only two countries are the exception. I think Sing dollar and RMB will buck the trend. Okay, but I think once they start tapering, once they stop reducing the buyback, US dollar will strengthen. The money that's flowing into the US will continue. Okay, let's have a look at this. When he mentioned the word tapering, you can see there's a lot of money flowing into US equities. There's a lot of money flowing out of bonds and fixed income. Okay, so in Singapore, you will notice, and I'll talk about it later, all our REITs, which were plus for the year, are all now minus. Okay, so people are now moving away from fixed income instruments into equities. And look at this, there's a lot of money. So what I'm saying now is there is going to be a bull market, but it's going to be a US dollar bull market. It's going to be the US market. Okay. Now, TK talked to you about the US economy growing at 3%. The key thing is that corporate America is very strong. Corporate America hasn't been investing. When the economy recovers and they start investing, you will find that earnings growth in the US will rise strongly. Okay, and that will support what I think the rally. So we've got another 2 years. So I think what's going to happen is that a lot of mutual fund money will move out of emerging markets into the US market. Okay, so what does this mean? If the 10-year treasuries rise to 4 to 5%, to me it means that a fair PE is 13 times. Okay, so 13 times is now fair and long-term. Okay, so for the markets to rally, we have to see earnings growth. Okay, so we are not, if we don't see earnings growth, then the market cannot rally. Okay, so what is the effect of QE 1, 2, 3? I think you will notice that there are asset bubbles because the money had to flow somewhere. There is huge overbuilding because the cost of borrowing was too low. So if you look at the shipping industry, if you look at the companies in China, there's a lot of speculative building. Okay, so when interest rates go up, there'll be a huge overcapacity. So what I'm trying to say to you is that overcapacity, the market must pay for it. Okay? And I think finally, we may get a credit crunch because people have borrowed and it's too cheap and they cannot reach the cost of capital. Okay? So what is my view on Singapore? Just quickly. I think the market is looking topish at 3003. I think it will go down to 2009. Okay? So I'm telling you, it's time to start selling it. Now this is what I got off Bloomberg. Okay, so the PE of the market is about 13 times for last year. This year is 14, so there's earnings decline of 10%. Next year we're looking at 8% earnings growth. So to me, the market is not cheap. It's actually fairly valued. It's fairly valued. Okay? So the key thing is what's going to happen to earnings. If companies give earnings which are missing expectations, the market will decline. And the key sector that you have to look up for is the banks. Because the banks are the biggest part of the index. Okay? So let me just touch on the electronic sector first. Okay? It's a tale of two totally opposite companies. Hard disk is still very bad. Okay? So we look at it. This year, total world hard disk demand down 12%. Next year, down 4%. So it's too early to look at the hard disk sector. Okay, so don't need to look. So your companies like Broadway, all that, don't need to look. Okay. The one that's recovering is actually the semicon equipment market. where GEP used to be. Okay. So you see the book-to-bill ratio is improving, and if you talk to the companies, they are seeing an improvement in the second half of this year. Okay? So if you look at Singapore's industrial production numbers that came out 2 days ago, semicon equipment was actually up about 12%. And the next day, you will find that two stocks in the semicon sector actually started to move up. There was ASTI and AEM. So the market is actually looking at. So if you want to be in electronics, I think semicon equipment is the place to be, not this track. Property, I think, no need to talk. Okay. The reason is that the government seems to be fixed on trying to bring property prices down. Okay? But they've had about 9 to 10 measures. I think the killer is this last one, TDSR. Okay? So when your TDSR is 60%, it's going to be very hard for property prices to go higher. Okay? I know of a lot of people who have sold their properties, they find that the buyers cannot raise the money because the banks, when they evaluate the buyer's debt servicing, they don't meet the TDSR. Okay? So where I think what happens is that we are likely to see a decline in property prices led by the secondary market. The reason is that the developers have made a lot of money. So although they paid for land at a high price, they can hold on, they need to sell at a loss. But the people who speculated, who invested, when the TOP comes and you cannot service your ratio, that is where you will see the pricing. So I'll give you an example. The Leader, which is part of Capital Land, they launched at 1,008. Now they're selling at 1,002. And that's in Holland Road. Why would you pay 1,002 for Pasir Ris or what? So you can see that there's actually pressure coming already. So property sector, I think no need to look. But this is the most important one, the banks. I find this figure very worrying. I think MES should find it worrying too. The loan deposit ratio of the banking sector in July, went past 100%. Okay, what it means is that if the banks want to lend some more, they have to raise deposits. So how do you raise deposits? You have to raise deposit rates. Okay. So I think there's a signal that I think that you will find that deposit rates will start to go up, and so will lending rates. Okay. So that will be the start of what I call the credit crunch. Okay. Now the other thing that's worrying and why you recently find the MES is putting on all these curbs. Did you know that every month when you get your credit card bill, you have a minimum sum, right? So the balance that you don't pay, we call credit card rollover. The credit card rollover as of July this year is $5 billion, and you are paying 24% interest. Okay, so the MES is worried that this is going to burst. But once interest rates start to move up, what's going to happen? So if you look at the two together, interest rates going up, two, people are highly leveraged, then I think you're looking at a rise in the bad loan cycle for banks. Okay? So I think you will start to see bank NPL start to increase over the next few months. In Singapore banks, about 60% of their loans are property related. Okay? So that will be the first sign that I'm looking at. That the banks, and now if the banks are 35-40% of the index, once the banks start to increase their NPLs and the profit is not there, then you will start to see the index start to decline. Okay, so this is what we think of the banks. Okay? Why we have an underweight? Because we think most of the banks are overvalued except for UOB. Okay, so how is the market going to go up? Okay, so I gave you my fair value target. Yeah, okay, so what I'm trying to say to you is that wait for the stock prices to drop, then you can start buying. Okay. So there's no need to rush to the banks now. The sector is an underweight for us. I think it should be in defensive stocks. Healthcare I just mentioned, but let's talk about the big companies like Raffles Medical are too expensive, so look at the smaller companies. You can find some value there. We have just produced 3 reports on the healthcare sector. You can go and read them. Now, telcos are also defensive stocks, but the 3 companies currently have a dividend yield of 4 to 5%. Okay. I think if interest rates are going up, then they are probably 10% overvalued. Okay? Because what I think is that you need to see a yield of at least 5+%. Okay? So I think wait for all of them to drop 10%, then I think they're worth accumulating. They're too expensive now. Okay? As the mutual funds start to move money out of emerging markets, you will start to see weakness, particularly in Singtel, which is a major index. Okay? So don't buy now, wait for 10% correction, you can start buying. Okay, REITs, I think, were darling last year. This year, 90% of them are down. Okay, so let's have a look. I just picked a few REITs just to show you. I think there are 29 REITs in Singapore. Only 2 are up. Okay, SPH and PL REIT. Okay, all the rest are down. Okay, so I think you should be looking at REITs where the yield is more than 6-7%. Okay? But when you look at the REITs, please look at also the gearing ratio, because if interest rates start to rise, then there might be an adjustment in the gearing ratio because of a re-evaluation of the capital values. I think you should look at OUE REIT, I like that. Capital Mall, and probably Fraser Commercial. Okay? So have a look at these. I think they are reasonable to look at. Watch out for the gearing ratio. Okay? Because when interest rates start to rise, you might start to see them revaluing their property and the gearing might move up. Okay? So the message is they're looking interesting, but some of them you can start accumulating now. I think others you have to wait. So for example, Capital Mall, I suggest you wait until the yield passes 6%. But I think for the other 2, they look reasonable now. Oil and gas sector, I still like it. I think it should be in the sector. It's the only sector that is providing quite strong earnings growth. Okay, just some brief numbers. I think basically the oil exploration activity has to continue. Okay? So the key thing that you need to watch out for is, as long as crude oil stays above $100 a barrel, the oil companies will be quite busy with exploration. The reason is that the global reserves are only 60 years left. Okay? Watch out for this thing called shale oil, shale gas. Okay? It potentially has got 5 times the supply of crude oil, but right now it's not commercially viable. But if you see news that it is starting to be commercially viable, then it could affect the sector. But until now, it's not been affected. That's a sector you should be looking at. Okay? So I like the rig market. So I think you can look at rig builders like Keppel. I like that. I think you can look at Jaya. I like Jaya. So some of the companies in the OSV, which is supporting industry for rigs. Or you could look at companies that are like Atlantic. But Atlantic, there's no liquidity. We'll see how we can help the company address the liquidity issue. In the same space, we have companies like Ezion. But to me, why are you paying 16, 17 times PE when the rest of the sector is 7, 8 times? So I think, again, a bit like Raffles Medical, look at the cheaper companies in the sector, don't look at the more expensive ones. Okay, so I'm just trying to show you that the rig orders are very good. There is some competition from China, but the quality is not good enough, so I'm not so worried. Okay, now, I'll just give you a health warning here. Most of the rig building customers were traditionally financed by the European banks. Okay. Most of the European banks, especially the Norwegian banks, are all bankrupt. Okay. So when you see a company like Keppel or Sembcorp Marine telling you they've got a $4-5 billion order book or a $10 billion order book, these companies are actually financing the customer themselves. Okay. So the key thing that you should be looking at is what is the is there a break clause in the agreement. So what's happening is that these companies are going to Keppel or Sembcorp Marine and saying, I'll pay you a 10% deposit, you build me a $500 million rig, I collect it in 3 years. Now, let's say I'm wrong. Let's say the oil price drops to $80 and the rig price collapses. Then the customer will say, yeah, I forfeit my deposit. Okay, so you could have a potential weakness in the order book. Okay, but as of now, I don't see it. But I'm just saying, let's be careful that a lot of the rig companies today are financing the orders themselves. Okay, so if the crude oil price drops, then there's a possibility that the order book may suddenly disappear. The rig builders suddenly become rig owner because the customers are only paying for 10% option. But right now I'm saying it's okay, you can look at the sector. Keppel is a lot cheaper than Sembcorp Marine. Let's look at Keppel. To me, look at Keppel and Giant, I think it's good enough for the sector. Okay, so my view, quick summary, I've got 2 minutes left. The Fed is going to start tapering. The key thing is US Treasury yields will be 4 to 5%, they are now 2.6%. Okay? 13 times PE is fair value. So if you look at the results season, if you see the earnings results are not so good, the market cannot rally because there's no earnings to drive the market. Okay? The other thing is that companies were enjoying interest rates which were well below the true cost of capital. It will take about 1-2 years or more for them to adjust for the overcapacity. That's why I think the earnings outlook will be no good. So for me, it is a bear, emerging market bear cycle. Okay, so if you invest overseas, I would say start to look at the US market. You should be selling emerging markets. Now, I didn't talk about, I guess it's just a summary. I didn't talk about gold. Okay. I think the party for gold is over. Okay. I think when gold went to 1,009, it was because nobody could see the end of QE3. Once we see the end of QE3 and the US dollar is going to strengthen, nobody will buy gold. Okay? So I think if you look at gold today, I think we're going to see, it's now 1,003 something. I think we're going to see further weakness. Gold is what I call in a bear trend. Okay, and because we have a view that the dollar is going to strengthen, you cannot be buying gold assets. Okay, does it make sense? Okay. So I'm trying to tell you, emerging markets are bad. The funds are going to flow out, sell into the rally, buy when things are 10% cheaper. Okay. I purposely didn't give you any stock picks because I'm not supposed to do that. It's supposed to be an education seminar. But I'm happy to take questions. I've got probably 5 minutes for questions. Are there any questions? Yes? Can you use the mic? Yeah.
Could you comment on commodity sector, like palm, for example?
Okay, I think the commodity boom that started when QE3 started was because people wanted a hedge against the weak US dollar. So they actually went into physical commodities and hedge. Okay, so now that I think the dollar is going to strengthen, commodity prices have to go back to normal demand and supply. Okay, I think the key question is what Basu talked about China. A lot of the commodity demand was speculative in anticipation of what China demand will be. Okay, so I think that demand isn't going to be that strong. So I would expect, given my view on the strength of the dollar and a subdued outlook for China, I think the commodity prices will see further weakness until prices normalize to what demand and supply is. There's no more speculative buying of commodities. Yes?
Recently, for the past few days, there's been a sudden surge of price in Yangzijiang, the shipbuilding company.
Yes.
Do you see any target price for this sudden surge? And I think currently a lot of people are worried about the China counters. Would it go like many of others, like Costco, in this manner?
I can't comment because they are one of our clients. But let me explain to you. I actually met them because they're one of our clients, and we were looking at an investment. But I think the problem that they have is that they don't know whether a lot of the customers which gave them shipbuilding orders will pay. Okay, because there's a lot of speculative building. And the charter REITs cannot, that's why I said that the charter REITs cannot support. And so when I went to see them, they were looking at moving out of shipbuilding into rig building, which is also highly competitive because they don't know. So I would say that, and I told the owner's son, I said, in 3 years' time, you will not be a shipbuilder, you will be a ship owner. Okay? So I'm just saying to you, I think the rise seems to be premature in my opinion. Yes?
Hello. You make some assessment on the property market in Singapore, which it seemed to me differs from Mr. Basu's assessment. Could you elaborate your comment with respect to his comments?
Mr. Basu is a lot smarter than me. No, I think Mr. Basu is using a macro indicator. Is that correct? I think the other figure which you should also look at, and probably which affects most of us, is the Gini coefficient. It's called the income gap. Okay. Now I think, as far as I can remember, the last statistics I had, the average per capita income of the lowest 10% of households in Singapore is $400. And the household size, let's say, is 3.5. Okay, so let's say that means that the average household income is about 1,500. And the average household per capita income of the highest group is 35,000. Okay, so maybe what is happening is that for all of us, we are in the lower group, so we don't actually see that. So this is what PK is talking about. There's a huge increase in income, but maybe we are not feeling it because we are in the widening of the income gap. That's my personal view. Okay. So I think if you look at what MES is doing, the TDSR seems to be signaling that the MES is concerned that people are over-leveraging in investment assets. Okay, so I think they have no issue if you buy the property to stay. But I think people are speculating too much. And because of that, you find that the loan deposit ratio of the banking sector is more than 100%. Okay. So if you are, for these investors to get out of their investment properties, if they find a buyer, the buyer must be able to find financing. So if you go to the bank today and the bank will say, okay, your TDSR you don't meet, then what's going to happen? So I think that will be the key problem going forward, is that the buyers cannot raise financing. Okay? And I think probably MES is probably seeing more than we are seeing. I think the fact that they are coming up very strongly, I think they are worried about the potential rise in interest rates and potential credit cuts. Because I think a lot of us, not us, our age group, but the younger group could be overspending, over-leveraged. That is why when they calculate your TDSR, they only take 30% of rental income, okay, before they will take 100%. They also take into account, let's say if you buy a $30,000 watch over 36 months, they also take that as part of your debt. Okay, so they are realizing that because the banks were very loose in their credit expansion, in particular in the credit card unsecured market, they have created a potential asset bubble there. So I'm cautious.
Hi. I understand that you are bearish on Singapore physical properties, but what about property stocks? Because they are trading about maybe around 30% below their RMAV. Yeah.
Yes.
So what's your opinion on property stocks in Singapore?
I think property stocks are probably discounting the physical market. Okay, so there could be some opportunity there, but I think the key question you have to ask is, were these companies aggressively building their land bank at a much higher price? And do they have the holding ability for the land that they have acquired given that you know that the government has a certain threshold that when you buy the land, you have to develop and sell within a certain time. Okay, so I think if you want to look at that, I think that's probably a good strategy to look at. You have to look at the companies which have not been that aggressive in their land banking and look at the pricing of their land banking, because they have to tolerate, in my opinion, a 10-20% decline in property prices. That's what I'm looking at for the private sector. Are we okay? Okay, I'm told to stop talking. So anyway, most of the slides from the presenters are on the website, so you can go and have a look. One more question. Okay, one more. Is there one more question? Yeah, sure.
I like your view. Okay, in contrast to the Chinese property market, the Chinese stock market appear to have this fear factor. Its valuation is probably factoring some form of fear. So what's your view of the Chinese equity market? I mean, compared to emerging markets, it's also relatively low compared to other emerging markets.
I don't follow the Chinese market, sorry, but I can use some of my intuitive feeling. I think if we can believe the reported earnings, it used to trade at 60 times PE, is now trading in the mid-teens. So if the numbers are accurate, the market looks attractive. But because we have no confidence in the numbers, how are you going to unlock the value? Okay, so they have what I think is a crisis of confidence. So you have the same problem in Singapore. A lot of investors don't trust the accounts of the Chinese companies. So even though on paper it looks very cheap, why would you buy it? Because tomorrow the numbers could be totally wrong. Okay. So I think the companies need to demonstrate over time. So over time, when the company delivers the numbers, to me, for a Chinese company, let's say listed in Singapore, the true test for them is the money there. Okay. So if the money is there, they can pay dividend. So if you ask me, if you want to buy a S-chip, make sure they pay regular dividend because it means that cash is there. Okay, but yeah, I don't cover the sector, so I said, but no, but I'm trying to tell you that I think people don't trust the financial numbers. So it will take a long time to rebuild confidence in the sector. But don't forget, China used to trade at 60 times PE, now it's 16. So on paper, it looks reasonable. But whether the number is real, nobody knows. Okay? Thank you very much.